Hey everyone, welcome back to the Weekend Charts, where I run through the most important charts and themes in markets and investing. Huge show for you today. A lot to talk about. Today's show is brought to you by my friends at YCharts. YCharts is an awesome data analytics and charting platform that I use every single day. Take a look at the show notes for a link to 20% off when you first sign up for the service and a free trial as well. Next week, I'm doing a webinar with YCharts. I'll have a link to that in the show notes. So take a look at that. We do this once a quarter. Going to discuss the most important charts and themes and markets today. A lot of good material in there. October 13th, 1 p.m. Central, 2 p.m. Eastern Time. If you can't make it, then register and we'll send you a replay. So be sure to check that out. There'll be a Q&A session as well at the end. So let's start out by talking about the equity markets, what went on in September. We finally saw lower lows for the S&P, and every couple of weeks in the summer while the market was rallying, I would ask this question: was the June low the low for the bear market, or are we going to see lower lows ahead? If you voted lower lows ahead, that was the right bet. We saw the market break those lows here in late September, and now we have four failed bounces. So as we've talked about, during longer term bear markets that are not just a short period of time like we saw in March 2020, but that lasts for months and maybe into years, what you see is these huge snapback rallies followed by lower lows ahead. So we had this almost 19% rally off of the June low, and all of those gains given back with the lower low here. So where are we now in terms of the bear market? We're down 25.6% from the peak on January 4th. That's the largest correction, of course, since the March 2020 correction. And in terms of duration, I think this is more important because, as you can see here, a lot of these corrections were very short-lived, measured in days or weeks. And here we are talking about a correction now that is at 269 days and counting. So that's the longest we've seen since the March 2009 low. And what that means is it's the longest bear market that we've seen since that 2007 to 2009 bear market. So we had this buy the dip mentality that we've talked about for years following that March 2000 low, where pretty much every dip was pretty short-lived, and you saw a vertical almost rally back to new highs following those lows. And this year has been very different, where you've seen some sharp snapback rallies, but no march straight up to new highs. We've seen lower lows now 4 times following these big rallies. So in terms of bear markets, as we've talked about, every bear market's different. You see a lot of variability from one bear market to another. We have bear markets that are just 20%, 3 months. We had the shortest bear market in history in 2020 at 1 month. And then you have these really long bear markets, 31 months and 17 months, from 2002 to 2002 and 2007 and 2009 that both declined over 50%. So where are we today? Well, it depends on whether you think this is going to be one of those longer term bear markets or somewhere in between. Obviously, it's no longer can be considered one of these short and shallow bear markets. And so in terms of averages, and there's a lot of variability around the average. The average of all bear markets since 1929 is around a 36% decline, median 29% decline. So if you're looking at the median, we're essentially almost there. But the big question is whether the economy is in a recession, because during recessionary bear markets, you tend to see bigger declines and you tend to see them last longer. So if this is a recessionary bear market, maybe we're only halfway there in terms of the duration. Maybe we have more downside to go. Are we in a recession? I think every single day, more and more people are kind of coming to that opinion. Most of the data points today are showing that, the exception being the employment in terms of the unemployment rate and the continued growth in jobs. But that seems to be an outlier. Everything else seems to be pointing to situations that we've seen in recessions. And this is a big one that I've talked about in prior months, but I'll bring it up again today because we're still at these levels that have been consistent with recession in the past. This is ISM manufacturing looking at new orders minus inventory. So new orders are going down, inventory is rising, and that's what you tend to see during recessions. And if we look at the last 5 times we've seen that this spread, this negative, the U.S. economy has already been in a recession. So we have the 2 consecutive quarters of negative GDP. We have indicators like this. We have all the housing market data that tends to be leading indicators of recession: housing starts, home sales, and the like. So we have all of these data points, not to mention, of course, the stock market as well, pointing to an economic downturn, but we don't yet have that confirmation from the NBER, and we don't have the Fed acknowledging it yet, or the federal government. So, what's been different about this recession this year from prior recessions in recent years? Well, you're not getting safety from the safety trade. So, if we look at the 2020 recession, or we look at the recession from 2008 to 2009, or if we look at the recession in 2001 or 1990, what was the Fed doing in all of those recessions? What they were doing was cutting interest rates. They were easing monetary policy, and you actually saw interest rates move down across the board because you had inflation rates going down. During a recession, you tend to see demand go down. We're seeing that, a little bit of that this year, and you tend to see prices come down and interest rates fall. And so, in terms of 2022, we're seeing the exact opposite. Of course, we've seen the Fed hiking interest rates. They've hiked 300 basis points now, with the expectation they're going to continue to hike in November and December. And you've seen Treasury bonds of all maturities really move higher. So the short end of the curve here moving up in lockstep with the Fed, and the longer end of the curve moving higher, as well as inflation hit a 40-year high this year. So big difference during this recession is that interest rates moving in the other direction, Fed policy tightening. We haven't seen the Fed tighten policy in a bear market, as we've talked about, since the early 1980s, and not coincidentally, that was the last time inflation was this high. So different reaction, because the different macro environment, where inflation for now is still the bigger concern for the Fed than even the economy going into a recession, and so interest rates are moving in that direction because of those factors, and that's causing pain in the bond market. So, what's different about this bear market for stocks is we're seeing also a bear market in bonds. And so, what we're seeing for bonds is what's now the worst drawdown in history for the U.S. bond market. So, the Bloomberg AG goes back to 1976. We're now at a 16% drawdown. That's the largest ever. And more importantly, is the duration of this drawdown: 26 months. So we're at over 2 years since the bond market peaked back in August 2020, when interest rates were very low. And because of that, because they were so low, any increase in interest rates is going to cause extreme pain for bondholders who have duration. So this is, I think, a more fascinating picture. It's looking at the 10-year Treasury bond going back to 1928. And it's pretty rare that both stocks and bonds are down together. We saw it in 1931, 41, 69, 2018, and we've seen it this year. But the big difference this year is the magnitude of the decline in both stocks and bonds. We've never seen both stocks and bonds down over 10% in a calendar year. And that's what we're seeing so far this year through the end of September. So a 60-40 investor of the S&P 500 and 10-year Treasury bonds is down 21% through September. That would be the second worst year in history if the year ended now, trailing only 1931. So you have to go back to the Great Depression to find a more difficult year for a diversified stock bond investor. And all of these declines, all of this downside is really shifting sentiment, 180-degree shift in sentiment from where it was last year. So last year we had this series of rolling manias, as I called them, from everything from the IPO market to SPACs, crypto, and so on and so forth. And sentiment was just so exuberant. We hadn't seen investors that exuberant really since the dot-com bubble. And now sentiment is gone in the other direction. And if we look at, we could look at any number of polls, but this is one that caught my eye last week, is looking at the AAI sentiment survey, the spread between bulls and bears. And this negative number here just means that the number of bears, people saying they were bearish on the stock market, was 43% higher than the percentage of people who said they were bullish on the stock market. And that's the widest spread that we've seen, the most negative investors that we've seen in history, with the exception of 2 data points. one being in March 2009 during the week of the lows of that bear market, and the other being in October of 1990. We had two data points that were lower than today. In October 2090 was when that bear market actually saw a bottom. The July through October 1990 bear market that was 3 months in duration, 20% in magnitude. So a very short list of time periods where investors in this particular poll were this bearish. And what does this mean for markets? Well, we always talk about tendencies, no certainties in market, just tendencies. And what we have tended to see following these extreme bearish, extreme fearful periods is actually above average forward returns for stocks. Looking out 3 months through 5 years, we see higher than the average returns, which is the opposite of what you tend to see when investors are extremely greedy. And so, looking at the top 3% of these values, so when bulls are much higher than bears, we tend to see below average, even negative performance here from 3 months to 1 year, but much below average performance going forward. So why do I say that fear is good? Well, fear creates opportunity. It creates the opportunity to buy in at stocks at lower prices, lower valuations, and as we've talked about in the past, when the market is so stretched where everyone's on one side, everybody's fearful. Well, then that tends to create an opportunity of a snapback rally because any bit of good news or even less bad news will be received positively by market participants. So, uh, importantly, not a holy grail. If we look at periods like 2008, or even early this year, we saw these negative sentiment extremes. And yes, you do tend to see very short term bounces, but perhaps those bounces are only last a week or even days, and then you see lower lows ahead. So is that possible? Certainly possible that could happen again, and certainly sentiment can still get more bearish. There's nothing to say that this number can't get more negative. We've seen it more negative. But overall, if you had to pick as a long-term investors, what would you rather see? Extreme fear or extreme greed? You'd have to say that you'd much rather see fear because that means there's much more opportunity. So another data point on that front in terms of the market being stretched to one side, there's an indicator that we talked about back in June. It's the percentage of stocks above their 50-day moving average in the S&P 500. And in June, we hit one of the lowest levels ever. We had that historic bounce. Then we actually got to an extreme overbought position, incredibly. But now it's come right back down to a very low level again. And what tends to happen, similar to sentiment, is you tend to see uh, similar to negative sentiment when you tend to see these snapback rallies above average forward returns following these extreme oversold conditions. And once again, same caveat. Does it happen all the time? No. 2008 being the most prominent example of the market can be very, very oversold, and then either bounce, come out of that, or bounce very quickly, only to go to lower lows. So that's certainly possible as well. But all else equal, if you're a long-term investor, rather see extreme oversold than extreme overbought. Um, let's talk about the data on large declines. Just looking at what happened in the first 9 months of this year and saying, in the past, when we've seen similar large declines, what has the market done going forward? So here, I wanted to broaden it to the Wilshire 5000. So S&P 500 is just covering the 500 largest stocks. The Wilshire 5000 is covering everything. So the entire U.S. Stock market. This is one of the worst 9 month periods we've ever seen, 25.9%. So not a small decline in the first 9 months of this year. If we stack up and we rank the 20 worst 9 month periods for this index, and we look out in the future, what we find is similar to that negative sentiment, similar to that oversold reading, what we tend to see is above average future returns going forward. And interestingly, we've never seen a market down this much over a 9 month period and not positive returns looking ahead 3 years, 5 years, 10 years. So if you have a long time horizon, you're not a trader, you're not you're not going to need the money in the next few months. You're in your 20s, 30s, or 40s. You have 20 plus years until retirement. You should be happy to see this type of oversold extreme because it means you're able to buy in at lower prices, lower valuations, and your forward returns. We don't know when this is going to happen, of course, but your forward returns are better than they were when we started the year. So where we are today is very different than where we were just 6, even 9 months ago, and certainly different than where we were in early 2021. And to me, that was really the peak of the mania. And it was really, why did I say that at the time? I wrote a few articles talking about the IPO market and just the flood of issuance that was coming out in the early part of 2021. You just had all the stars aligned for that to happen. You had peak investor optimism. You had the stimulus bills being passed. You had the economy already recovering. You had huge demand, retail sales exploding higher, and you had investor capital just seemed to be looking for the riskier and riskier home. So we saw a number of manias, of course, but the IPO mania was one of the most prominent that we've seen in recent years. You have to really go back to the dot-com bubble, which is what I wrote at the time, to find something this exuberant. But even that doesn't really compare to what we saw in early 2021. So we had $316 billion in issuance in 2021, with much of that happening in the first half of that year. Even the first quarter of that year, a lot of it was concentrated in that period of time. And this year, it's really slowed to a standstill. We're down to $19 billion in issuance year to date. That could be the lowest since 2016. If we continue at the current pace, and if the current pace slows, it could be the lowest since 2003. And so a very different environment. And what's driving that? Well, first and foremost, of course, prices. Prices are down. There's not as many companies that want to come to market today in terms of trying to cash out on that, trying to raise financing. They'll likely try to wait until a better environment where there's more demand. And so what was the backdrop? One of the big primary drivers of this explosion higher last year and now the move lower this year, well, it was macro conditions, and really a big part of that was the money supply. So we saw an unprecedented move higher in the money supply. That led to speculation in risky assets, that led to stock prices going up, housing prices going up, any number of asset classes pushing higher. And now we've seen the reverse. If we're looking at a 5-month rate of change here, we're actually seeing a negative move in the money supply for the first time in a 5-month period. You have to go back to 2004. So very rare for the money supply to show any contraction whatsoever. Obviously not a huge contraction here, but anything given what we had in 2020 and 2021 is a sharp reversal. So on a year-over-year basis, it's just an incredible shift here. So in February 2021, and that's when risky assets peaked. That's when the high growth segment peaked. Back in February 2021, you had money supply growth at 26.7% year over year. And since then, it's been gradually slowing, but just in the past month or two here, now we're back below the historical average with data going back to 1960. We're at 4% now year over year. So still up year over year, but a really rapid deceleration in this growth rate. And that's led to the opposite effect. So economic boost, or now we're seeing recessionary conditions. We went from mania in terms of sentiment to now we're seeing fearful conditions. And in terms of the IPO market, we're seeing that really dry up for now. So very different macro conditions. And if we're thinking about this chart in the next few months, I expect that it will likely continue to trend lower until there's a shift or a pivot in Fed policy. So until the Fed starts to say this is too much, it can't take the pain anymore, we're likely to continue to see this rate of change moderate, because the goal still is to bring down that rate of inflation. And we're just starting to see that move lower. So it's not enough yet, I think, for this to turn around. So what will the Fed be looking at to really make that pivot and go in the other direction, or at least pause on being so hawkish? I think inflation expectations are going to be one of the main things that they're looking at. And if we're looking at inflation expectations, these are market-based inflation expectations. So they're not polling people. It's just looking at the spread between TIPS, Treasury, inflation, protected securities, and similar duration Treasuries. And that spread is telling you what the market is thinking about the rate of inflation going forward. And here we're looking at a 10-year annualized rate. Right now, that is down to 2.15%. It was as high as 3%. So that's an 18-month low now. So moving lower, if that were to continue to move lower, I think even at the November Fed meeting, you would see a change in language. I think they might do that anyway, even if it doesn't go significantly lower, and saying they're going to slow down the rate of hikes from here. So inflation expectations coming down has really been a hallmark of economic weakness. So we saw it obviously during the 2008 recession, and we saw that back in 2020 during the recession back then. So if recessionary conditions continue, and if the money supply growth stays low, if the Fed keeps hiking interest rates, it'll be interesting to see if this continues to move lower and behaves more like a typical recession. But it's already starting to do that just from a much higher level at this point. So I think it's a very important data point to watch to kind of tell you when is the Fed going to move in the opposite direction. The market, of course, is predicting that's going to happen in the first quarter of next year, where the Fed pauses from hiking rates, and then at some point in the back half of 2023, they're going to cut rates. That's what the market's thinking now. The market could be wrong, of course, but that's the expectation. And in terms of another factor that the Fed is going to be looking at closely, it would be the housing market. And this is something we've talked a lot about, but we have to continue to talk about it because mortgage rates now have pushed up to 6.7%, highest since July 2007. And what impact is that having on the housing market? It's having a huge impact. You're not seeing it in the data just yet, but we're getting the first glimpse of it here in terms of looking at the Case-Shiller National Home Price Index. First decline that we've seen after 126 consecutive monthly increases. So you had increases from January 2012 through June of 2022, uninterrupted gains. And this is a seasonally adjusted index. Now you have the first decline since December 2011. So start of a shift, certainly a slowdown in the housing market, but starting to finally see that pullback in prices. And this, of course, is a lagging index. We have more recent data out of Redfin showing that prices are down around 6% from their peak back in June. So that's one thing in terms of home prices. What's going on in rents? Well, rents had been hitting new highs every single month this year if we're looking at just the average price of a rent in the US, but the rate of change had been slowing every single month, and now we're seeing an outright decline in US rents in September for the first time this year. So very different situation if rents start moving lower. We've talked about how important housing is to CPI. It's a third of the index. We've also talked about it's calculated very weird in the CPI, so there's kind of a lag in terms of reflecting the actual price increases or downside moves in the housing inflation. And as of last month, we were still playing catch up, where even though this rate of change is decelerated in terms of rents and home prices, the CPI component is still moving higher on a year-over-year basis. So if this were to continue, at some point next year, likely we'd see that reflected in CPI moving lower. But before it gets to that point, the market inflation expectations are going to reflect that. And I think that's what you saw in that break-even inflation chart. So why, in terms of interest rates and in terms of debt, why is it so difficult? What's going on this year in terms of for the debt market and for the federal government in terms of servicing that debt? Well, you have $31 trillion now in national debt. This is a new high that we just hit. I put together this table of debt milestones. And as you can see, over the past few years here, we've seen a number of trillion-dollar milestones. So each of these are a trillion-dollar increase in national debt. We started at here 3 years ago at 23 trillion, and we've had an $8 trillion increase in just 3 years. So how did that happen? You know the story by now. We had all of these different stimulus bills. We had a huge increase in the deficit. So simply we're borrowing from the future to spend more money today. And everyone seemed to be on board with that in 2020 because of what happened during the COVID and shutting down the economy. But now it's starting to get to a situation where it's pretty serious. And why is it serious? Because interest rates, when they're very low, the interest on that debt is not very meaningful. But when interest rates rise, that changes. So we're seeing interest rates of all maturities move higher. So as these government bonds mature, they have to issue new debt at higher interest rates. That causes higher interest rate expense. And so this number here is expected to continue to increase. It's likely to be over $1 trillion as we enter 2023, if we're looking at a rolling 12-month period. So uh, at a certain point, this is going to become problematic, and there'll have to be a debate about what to do about it. I think there's going to be a lot of people pushing the Fed, and they seem to already be pushing the Fed, saying you can't raise interest rates anymore because the debt's too high, and how are we ever going to pay that back? So there's going to be a debate that goes on where people are saying there's too much pain. We just have to go back to what we were doing before. We have to print more money to get ourselves out of this. Let the Fed start buying bonds again, push interest rates down. Then we could borrow more money and not worry about this. So of course, we know that would lead to more inflation and bad things. But I think there's going to be a push for the Fed to do that because there's already people talking about the Fed having made a policy mistake. So there's a lot of chatter going on pundits who are saying the Fed raising interest rates 3% like they did this year was a policy mistake. They're saying because the economic growth now is slowing, the housing market is turning down, because the stock market has gone down, and therefore that's a policy mistake. But if you look at a chart of CPI and the Fed funds rate, you can see that argument really doesn't hold much water because there's still a huge gap between the two. The Fed is still extremely easy in terms of their Fed funds rate compared to where CPI is. And so for the Fed to not have raised interest rates as much as they have this year would be tantamount to saying we're just going to ignore that mandate of price stability, which many of us argued last year they were ignoring that, and that was the real policy mistake. So that's the question, I think, is are you going to be saying that today in trying to bring the inflation rate down, which we all recognize as a problem, is the mistake, or was the mistake keeping rates low for too long, buying bonds for too long, or this 7-year period here where you held rates at interest rates at 0%, and the problems that build it out of that. So in my mind, the bigger mistake from the Fed is this boom and bust kind of monetary policy, this lagging reactive monetary policy, which is really built and engineered to create asset price inflation, to create these financial bubbles, which really don't benefit the real economy. So if you prop the price of a home up, as the Fed did, above where its true economic value is, that's not good for the real economy because now people are stretching and they're paying more for a house than they should be paying, and that crowds out investment in more productive areas. So by manipulating the rate of interest, the Fed is leading to a misallocation of capital, and there's a real economic cost to that long term. So my hope is that the mistake will be recognized, that the mistake was what happened that led to this, was the monetary and fiscal policies that led to this period of high inflation is the mistake and not the reaction today. So regardless of what's going on in the economy, because you have to take some pain to break the back of inflation, as we talked about back in early 1980s under Volcker. They understood that you had the tacit approval from Ronald Reagan saying we know this is going to lead to a recession if you hike interest rates up to 20% like the Fed did, but you have to do it because price stability is so important. So we're not anywhere near that today, and people are already saying we can't take the pain anymore. And I'm not suggesting that we need to hike interest rates to 20% today or anywhere near that, but to say that moving to 3% is a mistake when that's really just normalizing the rate of interest rates. If we look at the past 30 years or so, that's really nothing. I think that that's an error in judgment. And so what I would say to those people who are saying that the Fed should not worry about inflation and it's a mistake to continue hiking rates from here is where were you when the Fed and the government were increasing the money supply like they were doing in 2020 and 2021? This is not a small thing. This is not something that this inflation that we saw is not something that happened in a vacuum. We increased the money supply by over 40% in a 2 year period. And so to ignore that part of the equation and not learn from that and say, let's never do that again, I think that is the real error here. So if you listen to the Fed press conference, you'll probably be surprised that no one ever brings this up. There's never a discussion about the money supply, what the Fed has learned from that, and an assurance that they won't do something like that again. If we look at the most egregious error, I would say, in terms of Fed policy. And many people were calling this out, and I certainly was during the back half of 2020 and all throughout 2021. You had this evidence of a second home bubble brewing. All you have to do is look at home prices relative to inflation, and that tells the story of our housing prices in a bubble. And when they get too far above the rate of inflation, well, then you have a problematic situation on your hands. We had that, of course, during the 2000s, and then we had it again here. And you could argue, well, what you could say, what was the Fed's role in that? Well, perhaps people were going to speculate anyway, and we will never know what would have happened. But we do know what the Fed was doing, and what the Fed was doing was holding interest rates at 0% when you had this rampant speculative activity. And not only that, but they were buying mortgage bonds every single month during this period of time where home prices were going higher and higher and higher. So they're driving the mortgage rate lower and lower, pushing people into higher and higher home prices. And that has to be called into question. Someone should be asking the Fed what they were thinking in doing that. You had all of the evidence suggesting that the housing market was in a bubble, and they were still adding fuel to the fire. So, in terms of mistakes, you have to keep. There's plenty to go around, and we can debate where the Fed funds rate should be today, but there shouldn't be much debate about what caused this. It was excessive fiscal and monetary policy, and we have to learn from that so we don't repeat it again in the future. Let's talk about currency markets here. This is a historic thing. We'll very quickly cover this because I talked about this on the last video. The pound hit an all-time low against the dollar in late September there. And it's just an incredible thing that we saw, a credible sharp move lower. And with that, you had government bond yields in the UK just surging upward. So you had just a huge increase in long-term government bonds in the UK. And the Bank of England finally said at one point they had enough, and they stepped in and started buying UK government bonds again, trying to push interest rates lower again. So interesting thing to witness here. Calls into question it calls into question how much the Fed can continue to do what they're doing before they too reverse course, because the Bank of England was actually set to start selling off part of their balance sheet, so doing quantitative tightening like the Fed has very slowly started over the past few months. And then this happened, and they immediately reversed course and came back right in and started easing again. So it's kind of a circular thing. And once you get into that period of time, it's very hard to step away from the markets when you've been influencing it for so long. So this is something that's caused a lot of turmoil in markets in recent weeks in terms of the currency moves. And we talked about how the dollar has exploded higher, 20-year highs in the dollar, and we've seen just really every other currency against the dollar move lower. But again, this is all about expectations, and the market expectations is that the Bank of England, even though they're jumping in and buying bonds again, they still need to raise interest rates, and the market is expecting them to continue to raise. They're expecting the ECB to be more aggressive in hiking rates. So at a certain point, the market will have to make that determination weighing the Fed's policy versus the other central banks. And you may have a situation where these other central banks are exceeding the Fed in terms of their tightening, and that would lead to the dollar to come down again. So no predictions there. It's it's very hard to predict currency movements, but this has been a huge, obviously, downward trend for some time in terms of the British pound and other currencies against the dollar. So it wouldn't be surprising to see a snapback move in the other direction at some point. So let's end with something positive, like we always like to do. There's been a lot of negativity, a lot of downside, but what's the upside of this downside, I think, is clear if you look at this chart here. Every single asset class that you look at is in a better position today than it was at the end of 2021. I don't make that point lightly. I make it based on data. If you're a cash investor and you don't like to take any risk, you can now get above 3% in an online savings account. As we talked to, FDIC insured, you can buy 3-month Treasury bills and get over 3%. And entering the year, you're getting nothing. If you're a longer term bond market investor, again, if you bought something entering the year, you've experienced your worst return in history. But if you're coming in today and looking at that, you're going to get a much better return. So 10-year Treasury bonds more than doubled the yield year to date. And that is the best predictor of future returns for the bond market. So coming into the year, 10-year return, if we're looking at this 1.5%, now it's a reasonable expectation that you can get close to 4% on bonds going forward from here. That doesn't mean 4% is going to happen every year. That means an annualized rate of return through the end. In the short term, all that matters is the direction of interest rates. So if interest rates continue to rise, prices will continue to fall. But now you have much more cushion in terms of that yield. So a 10-year Treasury bond, when this bear market started back in 2020, it had a low of 30 basis points. So you had no cushion when interest rates rose. Today, at least you have a cushion on that, and that's a very good thing. If we're moving up the risk spectrum, investment grade bonds entered the year 2.35%. They hit record lows last year in terms of yields. Now they're at 5.7%. Much better situation. Again, very high correlation, similar to Treasury bonds, starting rate of return and your future returns. So you were looking, I called investment grade bond yields the worst risk reward in history back in 2020 when they hit record lows. And now you have a much better risk reward. High yield bonds, similar story here. We hit record lows actually below 4% in 2021, ended the year at 435. We're now at 9.5% as of the end of September. So much better risk reward in high yield bonds. That could certainly go higher. If the equity market goes lower, you could see this rise well above 10%, but certainly a better situation if you're a high yield bond investor. If we look at REITs, real estate investment trusts, they had ultra low yields for a long time, and a lot of that was just off of bond yields in general. There was a low yield on real estate, but that's changing too. As prices have gone down, the yield on REITs has gone up. Much better risk reward today than where you were at the start of the year. And finally, if we look at the stock market, dividend yield was close to all-time lows entering the year, 1.29%. Now we're up to 1.73%. If stocks continue to go down, that will go up even further. So as valuations on stocks go down, the prospective returns go up. So every single asset class better positioned today than we were at the start of the year, and that is the upside of downside. So we'll end there. Have a great rest of the week. Have a great weekend. Thanks for joining me, and we'll see you next time.